Bitcoin ETF outflows are hitting the gas, and exchange order books are looking terrifyingly thin. Every headline is painting a grim picture. With prices down more than 30% from the recent all-time high, it looks like every investor is sprinting for the exits. But they are missing the real story. The mainstream narrative is all about fear, weakness, and the end of the line for this rally. But what if the market has this completely backward? What if these so-called bearish signals aren't a reason to run and hide, but are actually the foundation for Bitcoin's next explosive move up? I'm going to show you why this is the exact setup we've seen right before previous massive rallies. This is a rare opportunity for anyone who knows how to read the data, not just the headlines. We're going to pull apart the fear piece by piece and reveal the powerful bullish case that's hiding in plain sight. First, let's tackle the elephant in the room. Those ETF outflows. There's no denying it. The numbers looked ugly for a second. After rocketing to a spectacular new all-time high in October, Bitcoin hit a wall and suffered a painful 36% correction, dropping into the high $80,000 range. Right after that peak, we saw a flood of money leaving the US spot Bitcoin ETFs. November had a net withdrawal of around $4 billion from these funds, a number that definitely spooked the market. Then, in mid-December, a few days of heavy back-to-back outflows had commentators screaming that the top was in. That's the picture the bears are painting. It looks clean, simple, and very, very scary. Price drops, big money pulls out. Story over. But that's not the whole story. It's not even the most important part. The very moment the selling pressure looked like it was peaking, the trend reversed, and it reversed hard. On December 17th, US spot Bitcoin ETFs saw a net inflow of over $457 million. This wasn't a trickle, it was a tidal wave. And it was led by the biggest players in finance. Fidelity's FBTC raked in a massive $391.5 million, and BlackRock's IBIT pulled in another $111.2 million. This was one of the biggest single-day inflows in months, proving that the second prices got attractive, institutional demand was right there waiting to buy the dip. But here's the single most important data point, the one that completely shatters the bearish story. While Bitcoin's price crashed by a brutal 36%, the total number of Bitcoin held in US spot ETFs fell by only 3.6%. Let that sink in. A 36% price collapse barely made a dent in the actual holdings. This is not what panicked institutions do. This is not a mass exodus. This is the signature of a market with incredibly strong hands. The core, long-term holders, the institutions who bought into the big picture case for Bitcoin, did not sell. They held on straight through the chaos. So who was selling? The data points to short-term players, momentum chasers, and leveraged accounts getting completely wiped out. That's exactly the kind of healthy market cleanse you want to see after a huge run-up. The outflows were just profit-taking, and a transfer from weak hands to strong hands, not some fundamental change in the institutional belief in Bitcoin. And that leads to the other big story here, the flight to quality. While Bitcoin ETFs saw this temporary rotation, things were much worse for other digital assets. Ethereum, for example, has been getting hammered. On December 16th, Ether ETFs saw a massive single-day outflow of roughly $225 million, capping off a very tough period for the asset. Analysts have been crystal clear about what's happening, calling it a flight to quality. When the market gets shaky, capital consolidates into the top-tier asset in the category. In the world of digital assets, that asset is Bitcoin. You can see this clearly in Bitcoin's market dominance, which has climbed back to nearly 60%, a high it hasn't seen in months. Capital isn't just leaving crypto. It's rotating out of more speculative assets and into the one with the strongest foundation and institutional track record, Bitcoin. This is the digital version of investors selling silver to buy gold in uncertain times. And we're watching it play out right now in these fund flows. To wrap up this point, the scary ETF outflows in the headlines weren't a sign of Wall Street abandoning Bitcoin. They were a sign of a healthy correction, a shakeout of nervous sellers, and a capital rotation that is making Bitcoin's position even stronger. The real holders are not budging. Now for the second bearish signal that everyone is getting wrong, the so-called empty or thin order books. You've probably seen it on social media, traders posting charts of exchange order books showing that the walls of buy and sell orders are way smaller than they used to be. The story goes that this means there's no liquidity, no interest from big players, and that the market is fragile and ready to collapse. And again, that sounds logical, but it completely misses the point of the market phase we're in. These thin order books aren't a problem, they're a feature of a pre-bull run launchpad. Think about what an order book actually is. A giant wall of sell orders is just heavy resistance. It means tons of people are lined up, ready to sell their Bitcoin the second the price ticks up. For the price to climb, buyers have to spend a massive amount of money to chew through that entire wall of supply. But what happens when the order books are thin on the sell side? It means the sellers are gone. They're exhausted. After a 36% correction, anyone who is going to panic sell has already sold. Anyone taking profits has already taken them. What's left is a vacuum of selling pressure. In an environment like this, it doesn't take a huge wave of buying to send the price soaring. A relatively small amount of demand can push the price up incredibly fast because there's nobody left to stand in the way. This is the textbook definition of a coiled spring. Institutional analysts have pointed this out, noting that order book depth often gets thin after big corrections. But they also note that the steady daily demand from the ETF issuers helps to build a structural floor under the price. The smart money, the huge institutions, don't telegraph their moves by placing massive, visible orders for everyone to see. They accumulate quietly. They soak up the light selling from the last few weak hands without revealing their true intentions. An empty order book isn't a sign of no interest. It's a sign that the fight between buyers and sellers is over because the sellers have already left the battlefield. This is the very essence of a consolidation and accumulation phase. It's the quiet before the storm. When you see shallow order books after a major correction, and combine that with the fact that long-term ETF holders aren't selling, it paints a powerful picture. The supply is locked up, and the resistance is gone. All it takes is a spark of new demand to ignite the whole thing. So, while the crowd looks at thin order books and sees fragility, what we're actually seeing is the launchpad. We're seeing a market where the path of least resistance is firmly to the upside. If you're getting value from this kind of deep dive analysis and want to stay ahead of the mainstream narrative, do me a favor and hit that subscribe button and turn on notifications. Here, we're all about breaking down what the smart money is actually doing, not what the headlines are screaming about. Your support helps us cut through the noise and deliver these data-driven insights. Okay, so what happens when you put these two giant clues together? On one side, you have the ETF ecosystem, where the core holders have proven they aren't scared, barely selling anything even during a massive price drop. This shows a new structural floor of demand for Bitcoin. On the other side, you have exhausted sellers and empty order books on exchanges, which means the available liquid supply, the Bitcoin that can be easily sold, is incredibly scarce. Resilient long-term holders plus a scarcity of short-term sellers is the classic recipe for a supply shock. This isn't some new crazy idea. This exact pattern has played out over and over in Bitcoin's history. You get a powerful parabolic run-up that pulls in a wave of new interest. That's followed by a sharp correction, usually around 30 to 40%. The correction is painful, but it's necessary to wash out all the excess leverage and speculation. Then, things go quiet. Prices move sideways, volatility dies down, and the headlines declare that the bubble has officially popped. But under the surface, the smart money is quietly accumulating from the weak hands who are selling at a loss. The data suggests this is precisely where we are right now. But this time, there's a game-changing difference: the spot ETFs. We now have a $100 billion plus machine that has fundamentally changed the supply and demand of this asset. This isn't just a few hedge funds anymore. We're talking about a product being integrated into the world's largest wealth management platforms, creating a steady, daily drip of structural demand. This all fits into the bigger macro picture. In a world where central banks seem unable to stop devaluing their currencies, the search for a trustworthy, non-government store of value is more critical than ever. For decades, that asset was gold. But now, Bitcoin is being seen as a superior alternative for our time, as digital gold. The recent flight to quality out of Ethereum and into Bitcoin is a perfect example of this thesis in action. While Ethereum is often compared to digital silver, a more volatile asset with more utility, Bitcoin is cementing its role as the global, neutral, pristine store of value. Its fixed supply of 21 million is a mathematical certainty, making it more and more attractive as investors lose faith in unpredictable government policies. On top of all that, the regulatory picture is slowly but surely getting clearer. Serious discussions about new digital asset frameworks in the US are aimed at creating clear rules for institutions. This will only de-risk the asset class further and unlock huge new waves of capital down the road. This isn't about hoping for a change. It's about watching the steady march of integration into the global financial system. So, what's the game plan? Well, nobody can predict the future, and we always have to consider the risks, especially in a potential recession. The data is telling a very compelling story. The current price range in the high 80,000s, which is held as a floor during this correction, is acting like a classic accumulation zone. The key takeaway is that the bearish signals are a mirage. The ETF outflows were just a temporary rotation that revealed an incredibly strong base of holders. The empty order books aren't a sign of weakness, they're a signal of seller exhaustion and the potential for a truly explosive move up. This setup is creating what could be one of the best buying opportunities of this entire market cycle. The fear in the market is real. Retail sentiment is in the gutter. Mainstream headlines are all negative. This is exactly the kind of environment where the biggest opportunities are found. With the institutionalization of Bitcoin, the days of 80% crashes may be over. The ETF structure provides a constant source of demand that acts as a buffer. While some institutional forecasts are staying conservative because of macro headwinds, many have extremely bullish outlooks for the next 12 to 18 months, all depending on continued inflows into these ETFs. The machine has been built. The capital is lined up. This current lull, this quiet period, is when the portfolios for the next major run are being built. Let's put a bow on it. The market sees headlines about ETF outflows and sees fear. We look at the data and see a healthy, necessary rotation into stronger hands. The market sees empty order books and sees weakness. We see an explosive launchpad, cleared of all resistance and ready for the next wave of demand. While the crowd is reading these signals as bearish, the on-chain and market data all point to the complete opposite. The stage is being set for a massive rally. The underlying structure of the Bitcoin market isn't getting weaker, it's getting stronger. The asset is maturing, cementing its position as a global macro asset and proving its resilience. This isn't the time to panic. This is the time to pay attention. For the investor who is willing to look past the noise and focus on the data, signals like these aren't a red flag, they're a giant green light. And while nothing is ever guaranteed, the evidence suggests this isn't just another dip. This could very well be the generational buying opportunity of this cycle. What are your thoughts? Are you seeing the same signals in the data? Or are you still feeling cautious about this market? I read every single comment, so let me know your thesis down below. And as always, please remember this is for informational purposes only and is not financial advice. Do your own research and make decisions based on your own situation. Thanks for watching, and I'll see you in the next one.